Welcome into today's presentation of the Capital Avalanche strategy presented by Money Insights. Hi everyone, my name is Christian Allen and I'm here with my business partner, also known as Rodney the Pod Zabriskie. Rod, what's up, man?
Hey, I'm great and I'm glad to be here. I'm excited.
I'm really excited about this because we've been talking about unveiling the Capital Avalanche strategy for some time.
Yeah.
We recorded the podcast. And now it's time to get the webinar put together. So let's do this thing. We're calling it, Rod, the safest way to leverage your way to wealth. I'm going to talk a little bit about how exactly that takes place. And maybe we'll start with some of the key or core benefits to utilizing the strategy at all. So the first thing is that there's a predictable double-digit return. And we don't use that lightly. Like, we know that there's not many places in the world that you can go to get a predictable double-digit return, but we genuinely believe the math suggests that this is a very safe and predictable way to produce a consistent and long-term double-digit return. The next thing here, Rod, is that it's maximum tax-free income. And we love tax-free income at Money Insights. That's what we're all about, right? This concept, this strategy produces tax-free income at an incredible rate. And we're going to talk a little bit about why. But the big reason is that we can just utilize leverage in a way that we haven't been able to previously. So it's really unique from that standpoint. It's a great way, Rod, to put inactive money to work. And we're going to show an example of what that actually looks like. There's checkbook access. In other words, our money is liquid. So if we need it, we can get to it. One of these examples Rod's going to talk about, like I said, is a lazy money or an emergency fund money situation where we put that into the Capital Avalanche. Well, we're going to show how you can do that, but still have the liquidity and checkbook access to make sure that you have money if and when you need it. It's a great way to provide liquidity for estate planning. We always have to bring it up because it's really powerful, even though we realize that most people don't get that excited about that component. But I promise if you're listening to this and you're a high income earner and or high net worth, then as we get older, this just becomes more and more important in our overall plan. And finally, we can create optimal leverage without any outside collateral. We emphasize that because we've talked to so many people over the last several years who are really intrigued and want to do traditional premium financing, but they struggle with that outside collateral requirement. And really, Rod, it makes sense because most people that we work with are really active with their investing. And so it's hard to have liquid money that's, say, in a liquid place like the market, right? And so collateral doesn't always line up with the types of people that we work with. So we're really, really excited to talk through how we can create that optimal leverage without any outside collateral. Next, what Rod's going to do is he's first going to talk us through like a graphic of how it actually works, what's happening inside the strategy. And then from there, we're going to jump over and run through some case studies or examples of situations that you could use the Capital Avalanche and that it would be incredibly impactful. So Rod, why don't you talk us through what it is? I'm excited to see exactly how people can be using this to help leverage their way to wealth.
What we're going to do is we're going to use Dr. Z. He's our little friend here. And
Dr. Z has great hair, Rod. I have to say it every time. It's only because I'm a little jealous, but Dr. Z has great hair. So it was a good choice on the graphic.
Yes. Okay, so here's Dr. Z, and he has a lump sum. So for this example, he's going to take that lump sum that was sitting in lazy money, and we're going to set up a life insurance policy, and he's going to move that lump sum into the life insurance policy. And why are we going to do that? Because it builds cash value, number one. That cash value is going to grow on a consistent basis. And once we plug in the leverage, the idea is that it's going to outpace any interest that we're accruing on the loan. So we create this arbitrage where we're creating more growth inside the policy than what we're accruing in the interest on the loan to, again, leverage our way to wealth. And let's talk about the life insurance policy because there are a couple of different types of insurance that we use. We use whole life, which is very consistent, predictable, has a lot of guarantees associated with it. We also have index universal life. It still has some guarantees, but it gives us a little more upside potential. And so we're not picky in this one. We can choose one or both of those in combination with each other. And so it's really up to the individual and how aggressive or less aggressive they want to be with it. But either way, we're going to be creating that arbitrage, higher growth inside the policy versus what we're accruing in the loan. So we go and create a relationship with the bank, set up a line of credit using the cash value in that policy as collateral, which immediately gives us checkbook access to the equity. In other words, we're going to have about 75 to 80% of what that initial lump sum was that went in that lands in the cash value. We now have access to it through this line of credit. And now's where it really gets interesting, because when we get to year two and the year two's premium is due, we're going to leverage that from the bank to fund not just year two, but all future premiums going into this policy for many years to come. All of that is going to come through leverage from the bank, which continues to build that cash value. And we're always outpacing. Our cash value is always higher than the loan balance and earning a higher return on average than what we're accruing in interest on the bank, and just turns into a really powerful engine to produce that wealth.
I like how you emphasized the arbitrage component, because really at the core of the concept, that's what it is. We're managing an arbitrage between the interest that we earn and the interest that we pay. Now, the nice thing is again, if we look at historical interest rates over many, many years and even decades, it's pretty easy to see the scenario how inside a properly structured life insurance policy, I can earn on average especially over a long period of time, a significantly better interest rate than I would have to pay. And that's really the name of the game. It's about managing and making that arbitrage as effective as possible. And we've got some great ways to pull levers and make sure we do exactly that.
Absolutely. And as we continue to build that equity, as you mentioned earlier, we have access to whatever equity we've built in. Another thing that we can do is we can use that equity to take out additional policies potentially, right? Depending on how much access we want to continue to have in terms of the liquidity. Not only that continuing funding on that first policy, but additional policies on top of it can be created to continue to build that leverage, just lever up those dollars that went in to make more of what Dr. Z put into it than he could create on his own.
We're leveraging the dollars at a higher level than we've been able to at any other strategy that we've used. It happens over time. And the reason that's significant is because by doing it over time, we can keep it all self-contained, right? Again, it goes back to that collateral component. In this example, we can have a 30 to 1, maybe a 50 to 1, depending on how many policies we decide to have and the time frame that we're using it. But I could have the significant leverage and do it all knowing that it's self-contained inside the policy. Never have to worry about outside collateral issues that could potentially come into play. So from that standpoint, there's higher leverage, but it's actually safer.
The next piece is we start to access this tax-free income as soon as we want. In a lot of these other premium finance strategies that we've talked about, there is a specific time frame before we can start taking the income out. And there are reasons for that, but it's often 15 years, sometimes more, depending on the specific strategy. Whereas with this one, because we are maintaining some of that liquidity, some of that equity access, we can start taking that income as soon as we want.
And that is something that is significantly different than some of the strategies we've been working with.
And then at the end, when Dr. Z passes, his death benefit passes on and creates this estate planning benefit that we talked about, or this liquidity that goes to help his children, his heirs, with liquidity needs, whether it's estate taxes or whether it's liquidity in conjunction with businesses or real estate or other things that are illiquid. Huge benefit for them. Look, they're very happy. Look at them.
Yeah, they are happy. Well said, Rod. I thought that was a really good overview of how the Capital Avalanche strategy works. So I'm excited to kind of jump into this next phase where we're going to hit on some actual example scenarios so people can really see where it will work in their world.
Perfect. First thing we're going to do is look at somewhat of a generic example. Just say, hey, again, Dr. Z, let's say he put in $500,000 into the Capital Avalanche strategy for that initial funding. Then what? Right? Give us kind of a feel for what that looks like. Well, immediately what happens is we have that cash value that shows up about $400,000. So again, about 80%. And
pretty typical of a max funded life insurance policy. And that's important, right? We use the exact same type of underlying policy. And what I mean there is that it's optimized for the policyholder to gain cash. Because of the leverage component, that'll dip a little bit, but then it will start to go back up. This example is a single premium, $500,000 going in from my pocket, the policyholder. From then on out, the bank is going to make all of the subsequent premiums. So what's happening again, single premium, bank does it, and they can do it as long as we want them to. Again, that's what makes this so unique. It's not a 10 or 15 year time frame. They can do it as long or really as short as we'd like them to. So it's really flexible and unique from that standpoint. Let's just next jump into a couple of these case studies where we can see what this is going to look like in our individual world.
First one we're going to do is we're actually going to piggyback off of what we just looked at, those numbers, going back to this whole idea of lazy money. And in this example, we're using a 45-year-old business owner who has $500,000 sitting in just their business reserves for payroll, rainy day, whatever, liquidity that a business owner just needs to keep on hand. And in the past, she's kept that in a bank account, earning the 0.1% or whatever. In this case, what we're going to do is shift that to the Capital Avalanche, where we can create those double-digit returns. In this example, 14.4% of a long-term IRR. For the short term, it creates that liquidity that she needs in her business. But then when it comes time where she retires, she's going to start living off of all the cool things that she's done for retirement income. Well, this becomes another piece of that and turns into $25 million of tax-free income for her through age 90. And not only that, when she passes away at 90, it also passes on a $12.5 million death benefit for her estate needs.
Those numbers are wild. So again, just to reiterate, $500,000 in one time, the bank's then putting the rest of it in. That's why we're still able to produce those kind of numbers. But then from $500K in, we're getting $25 million of tax-free income. Could be more, right? And
Sure.
$12.5 million of death benefits. So that's pretty wild. Good example, Rod. And just as a quick reminder, lazy money could mean a lot of things, but we're thinking of it could be rainy day, slush fund, emergency fund money, the types of things that are totally reasonable to have lazy money. So we're not suggesting that's like a bad thing. Everybody has some. We're just suggesting that this could then plug in as a really great place to make that lazy money start working for us.
And if you need to access it, you can, right?
Yep.
So she needs $100,000 for payroll. She takes an additional loan against the line of credit to cover that, replenishes it as quickly as possible, and it's all back. Just, again, the same as she would have done with the money sitting in the savings account.
Yep. All the while, it's now getting 14.4%. It's just wild.
Yep.
Okay, cool. Let's look at the next one.
For the next one, what I wanted to do is say, well, what if I have someone who is a high-income earner, in this case a 42-year-old surgeon, who would like to be able to participate in like a Roth IRA type of thing, like kind of the idea of the tax benefits that come with that. Obviously can't qualify though, right? Too high income, can't set up a Roth plan of his own. So in this case, we're going to set up a Capital Avalanche plan where he's setting in $100,000 a year for 10 years. Okay, so what's interesting about this one is, as we saw in the example, this first year he puts in the $100,000. Now we're financing $100,000 a year after that. Then in year two, what we do is we set up a second policy of $100,000 a year. He puts in the first $100,000. We finance again $100,000 after that. So we continue to stack these policies for 10 years so that by the time we get to year 11, he's now financing $1 million a year from then forward going into these policies that he's created, all working toward his future retirement, earning this 14.8% long-term IRR. And so in this case, when we measure that income coming back out, so $1 million total that he put in out of pocket, and then he's going to get $43.7 million of tax-free income through age 90 and an additional $31 million death benefit.
I don't really have any words, Rod. It's just pretty amazing. Okay, what's the next one?
Okay, the next one we wanted to show is someone who is doing some college planning. In this example, 38-year-old parents, they have a couple of kids that they're wanting to set aside money for their college funding. And I would say this could be really anything, any kind of future goals or big spending program that you know is coming could be plugged into the Capital Avalanche strategy. So in this example, they take $20,000 a year for 5 years, set that aside, stack 5 policies on top of each other, $20,000 a year. So it's a total of $100,000 going in, creating that 14% long-term IRR. In year 17, they start taking the funds out to pay for college for the kids. So for the next 6 years, they're able to access $61,000 a year to pay for college. But that's not it. They're going to retire soon thereafter. And so once the college is paid for, they start taking tax-free retirement income. They get a total of $6.6 million back out up to age 90, and then an additional $4 million of a death benefit.
So I really like that we're dual purposing in this example, right? We're taking money that we might have to be putting out either way, and we're just now making it more effective. We're not only going to utilize the policy, the concept for college funding, but it's going to be a powerful retirement income supplement to go along with it.
I think that's a great point, and I think that's consistent across all three, right? It was lazy money that we then turned into retirement income, or it was retirement income that also became an estate planning play, or in this case, the college planning that does the other two pieces as well.
I think it emphasizes the flexibility behind it, because really the idea is for it to produce cash. And once we have that cash, we can do whatever it is we want to. If it's going to be a significant death benefit for us, we could then down the road decide to use it more like the investment optimizer and just utilize it to run cash flow investments through. So it's really flexible in terms of what it can do. And that's again, one of the things that really gets me excited. Okay, so just a really quick overview of what we talked about. Inside the Capital Avalanche, you can expect to get a predictable double-digit return. It produces maximum tax-free income, and it can be optimized with either a single lump sum, which is just so huge because a lot of people don't love the idea of having to make a commitment to do something long-term. So in this example, it's optimized with a single lump sum, but it can also be stacked to where you can do it, making it look more like a traditional retirement plan where I'm making ongoing contributions. It's a really great place, Rod, to put inactive money, lazy money that needs to be on the sideline for whatever reason, but that we hate having it sit there in the bank earning nothing. There's checkbook access, which just means, again, that we can get to the money when we need it for whatever reason we need it. And finally, it is optimally leveraged without requiring any outside collateral. So for that reason, we genuinely believe that the Capital Avalanche strategy is the safest way to leverage your way to wealth.